Hi, everyone. Welcome to the Functional Retirement Podcast, where we merge retirement planning and health. I'm your host, Thatcher Taylor. I'm a certified financial planner. And on this podcast, we're going to explore the convergence of health with retirement planning and how it affects longevity risk, income distribution, protection, estate planning, and everything that goes into an optimal retirement. We're going to do that with some solo shows with myself, with educational videos and topics. But we're also going to utilize expert guests in the fields of retirement planning and health. So without further ado, let's get into it. All right, everyone, welcome back to the Functional Retirement Podcast. I'm your host, Thatcher Taylor, and I'm here with Jess, Bost, the Twitter master for converging financial planning and fitness. So we're essentially cut from the same cloth, and that's how we got introduced to each other, was just through Twitter. So the age-old stories of meeting friends on social media, this is an actual situation of that.
That's true.
So before we dive in, tell everyone a little bit about yourself. Tell everyone where you're at now and how you got to where you are.
Sure. Well, thank you, Thatcher, for that introduction. I will wear the crown of master today for the next few minutes, but thank you for that. Twitter is a funny universe, right? And I entered it because I was lonely in the profession of finance and curious in the profession of finance. And that kind of drove me into sort of a madhouse of opinions and ideas and a culture that once I realized that I could craft it a bit to what I wanted to see and hear, and also invite in other ideas that were kind and thoughtful, and kind of mute ideas that were not kind and thoughtful. But it has really allowed me to find some of my best friends, and so for that I'm so thankful. It's allowed me to connect with people like you, and it's just been a wonderful place to combat that loneliness in the field of finance. And so I was in finance. I just started out my journey in finance as a financial advisor whenever I landed on Twitter. And then over the last few years have continued to be a financial advisor for a small group of people, but landed a job with Alpha Architect, working with advisors. And so my role there kind of sits at the intersection of really smart quant finance people and advisors who are interested in what these really smart quant finance people know. And also at the same time, unsure, curious if they can trust them. And so I get to kind of go behind the scenes, behind the curtain, and decide and look and determine whether or not this team that I'm working with is trustworthy, which, spoiler alert, they are. Wouldn't still be there if they weren't. But then also help maybe craft that message back to advisors in a way that advisors can better understand about what they do, what the research they're doing, and what they're finding. And ultimately, what we've come to is how to help advisors create portfolios for their firms that matter to them, that have meaning, that they feel confident about, they feel convicted about what they're investing in on behalf of their clients, and then help them translate that into a message that clients understand and want to get on board with so that they can build their businesses. And so that's just been a really meaningful journey for me, because coming into finance late in life and figuring out that I love it here, because it's a lot like my previous work, my previous career in CrossFit, where I help people get from where they are to where they want to be. It's been really meaningful to carry that over into finance, and then now take it a step further into helping advisors get from where they are to where they want to be in their business, and then also translate that to clients and help clients get from where they are to where they want to be. And just the evolution of that for me has been really magical. So I love what I do. I love who I work with on both ends of the spectrum, my team, the advisors that we work with, and just feel really fortunate to have found this place in Twitter and finance.
Yeah, that's awesome. That's awesome. Thanks for sharing. And there's a lot that I want to talk about in that. I mean, you talked about CrossFit. We talked about the transition to helping out advisors. So from my experience in the financial planning world, it's been a complete 180, where my career started with Edward Jones and Thrivent Financial, where it's just find the clients, open the accounts, invest the money. And that's how you get paid. And then I spent 5.5 years in the ultra high net worth department at Vanguard. And so Vanguard gives you a completely different mentality. It's like you're baptized and washed clean for a minute about how to invest this different way in this Vanguard religion. You are on the front end of all the bogleheads. And yes, that's a term. Google that. It's literally a forum, the Bogleheads Forum. And so then you come out and you start to realize after that there's essentially 3 ways that people can invest, or an advisor can invest, where the company that they work for is going to provide them with some sort of portfolio strategy.
Yep.
The advisor can do it themselves.
Yep.
Or they can hire some sort of third party
to
help manage the assets for them so they can really focus on the clients. Now, it sounds like the third option is kind of what Alpha Architect is, right?
Sort of.
Yeah.
So I love that you said that. And so that third option, usually an advisor has to pay an extra fee that they end up usually passing on to the client for that, right? So there's usually, in our world, in advisor speak, we call it BIPs, but it's just a percentage points that's lopped on top of the fee that you're paying your advisor that pays for this extra service. And in a lot of cases, it's like one of those things where if you're investing your money, you want your advisor to be doing that thing with your money that is truly going to help you reach your goals. And if you found an advisor that you trust that does a great job with planning and filling in the rest of the gaps, then it's possibly likely worth it to pay a few extra percentage points to have them have a team of experts at their side saying we've crafted these portfolios for you so that you can be sure you're delivering something of high quality to your clients. So what we do for advisors, though, who are independent and want to build their own portfolios, and they manage some of the operational things that these third parties would otherwise manage for them. So they do the trading themselves, but we just help them create their portfolios. So we don't attach a fee to that. We are usually, as a process of working with that advisor, we're educating them about factors, which is part of what we believe in. And we have built funds that help advisors invest in those factors specifically. And so our funds are part of that model. And in that case, there's no reason for us to charge twice because they're using our funds inside their model. And so it's a special situation where we feel like it's a win-win-win for everybody because we believe we're doing good work with increasing the quality of the characteristics inside the portfolio. We can show that through our data and our research and our own tools, how we're doing that. The advisor is educating themselves on something that's important to them. And the education is something that we can continue to do with them over our time and our relationship with them. The client doesn't pay anything extra because the advisor's not paying anything extra. So we feel like it's a good synergy, a good win-win-win. We're doing good work and everybody's getting a good outcome. So.
Yeah, absolutely. That's really interesting. So the factor portion of this, that's a little bit newer in the industry. So a lot of people know about mutual funds, actively managed mutual funds, and then they know about ETFs, and there's even active ETFs and then passive ETFs and index fund. But factors are the same investment, the investment types, the same structure, but they're investing a little bit differently. They're chasing a little bit different type of segments in the marketplace.
Yeah.
Develop these full portfolios. Can you talk a little bit more about factor investing?
Sure. So I like to think of factor investing as instead of using the word factor, I like to switch it out for characteristics because it kind of takes it into a word that makes a little more sense broadly. So factors are characteristics of companies. And when we talk about characteristics of companies, we're talking about how the characteristics inside market scenarios. So are those companies rapidly growing? We call that momentum. That's a momentum characteristic. Are those companies low cost? Are they cheap to buy relative to the value of their business? We call those value companies. And so we separate out these characteristics and we try to, or we've created funds that invest specifically in companies that adhere to these characteristics. And so, when we're building an overall portfolio, what that allows us to help an advisor do is build a core part of the portfolio that may invest in these, large, broad companies that most of us are familiar with, Lowe's, Home Depot, Apple, the Facebook, Google, those types of things, but then also invest in these other smaller companies that are low cost, that either have high momentum or good value based on their price point and their company metrics. And what it does is essentially we talk about diversity and diversifying inside our portfolio, which means we want to have a good broad sweep of investments inside our portfolio. Factor investing is a way to increase that diversification because we get to diversify out into other characteristics that may not be captured inside the FANG or the S&P 500 or those general stocks that are in most people's portfolios.
That's right. And so when you're working with an advisor, because going back kind of the three ways we do it, you work for Edward Jones, and there was a team at the time. This was almost 10 years ago, but there was a team of people back at the home office that picked a bunch of ETFs or mutual funds.
Yeah.
And then the advisors could choose from a lineup of managed portfolios. Well, if you're at Vanguard, the advisors will just use one of they call it the four totals.
Yeah.
And then they'll maybe overweight to something if the client wants a little bit more. And then there's advisors out in the world that are doing it themselves on behalf of the clients for no real additional fee.
Right.
So when an advisor comes to you, they're doing it themselves.
Yeah.
What type of mistakes do you see advisors make? And what are some areas that you look for that advisors should probably do a little bit better job at?
Oh, what a great question. Well, I'll take it back to a story and an analogy first, and then we'll bring it back into finance, if that's okay, because I think that's sometimes it's helpful to see. So when I'm coaching in the gym and a new client comes in that is familiar with fitness, maybe has been working out on their own, and they're being introduced, baptized, if you will, into the CrossFit way. There's usually a lot of either misconceptions that they have about what the purpose of a movement is, that has led them to either avoid it entirely. For example, I've had somebody tell me before that pull-ups are just for boys, or either they'll name girl push-ups, boy push-ups instead of push-ups on your toes and push-ups on your knees and things like that. And so it's just a misunderstanding of what the purpose of something is supposed to be inside fitness. We have people that are, they may be injured in some way, and so they have to work around some issues, whereas before they didn't know how to work around those issues. And so they just avoided using their left arm completely, so what we see those similar kinds of ideas when people come in with their portfolios. Either they have misconceptions about, what bonds are supposed to do inside a portfolio. For example, over the past, you have to kind of throw out the last couple of years because they've been so tough, market wise. But prior to that, from say 2010 to 2021 or so, you saw bonds have equity-like performance. And so what ended up happening, and what we see a lot of advisors doing, is chasing a safer equity-like performance with their bonds instead of allocating appropriately to equities, which should be in equities, and managing the risk and behavior of their client there, and then allocating to their bonds to something that actually moves in a way that does not correlate at all with equities. We've seen a lot of portfolios tilt toward bonds, corporate bonds that move with equities. And so that created a crisis for a lot of folks over the last couple of years because stocks went down and bonds went down too. And so we see a lot of just misunderstanding of asset classes in that way. We also see just a lot of people who are avoiding parts of their portfolio entirely, or avoiding things like that they just don't understand, avoiding things that maybe there's transitions that need to happen. They've owned T-Mobile and Verizon and Apple and Google, from previously held positions for a while and they don't know what to do with them. So they're just going to leave them there and just let them ride. They don't, those legacy positions that they're not really sure what to do with. And so we kind of help them map out how to make those changes. So there's a variety of things we see a lot of overlapping holdings just with as many products as there are in the world. We see people doing things that um, actually accomplish the same purpose as something else, just with different letters. And mutual funds that are higher cost than ETFs that are invested in the exact same holdings and accomplishing the exact same thing in the portfolio. So we work with them a lot to reduce their internal expenses and give either that back to the client or, shift things around so that they're actually exposed and diversified better across their portfolio for the same cost. There's a lot of different ways that we can help them and improve the value of what they're giving to their client at either same overall fee or a lot of times less. So.
Yeah, absolutely. The overlap's a big one, especially this day and age. You can have an ETF from BlackRock, from Vanguard, from Charles Schwab, from Fidelity. They all have different letters because they're all different funds. They have different fund managers. But just because they're from different companies, they could be very, very similar.
Yeah.
It's the overlap. And then the active management, capital gains, over trading. And then I really like what you discussed with the bonds. The misunderstanding of the purpose of a bond compared to an equity. I can't tell you how many times I have to step back and educate people about a stock is not a bond. They are completely different. They function completely different. So you can't use them the same way, especially after the past 12 years, how interest rates have been so low and bonds have performed equity like you mentioned, and interest rates change and bonds struggle. I love the pull-up analogy because there could be a strict pull-up, a kipping pull-up, a butterfly pull-up, a jumping pull-up. There are all so many different ways that you can do a pull-up and the purpose behind them. I think investments are very similar.
Yeah. Yeah, absolutely. Yeah. The analogy of the weight room is actually super helpful for clients because it's for most people, it's an intuitive one. Even if they haven't spent a lot of time inside the weight room, they can conceptualize, visualize what these things are. And whereas it's harder to do that when you're talking about a stock or a bond because it's an intangible idea to most people. And so, the function of why we put something in a portfolio, why are we doing this is always a question that we should be asking ourselves as we go through building a portfolio. Why are we putting this in here? What is its purpose? And the same question should be asked when we're, and applied to our fitness. Why are we doing this? What is the purpose of this? And building something strong and long-term in both fitness and finance, it requires a concept of many different types of investment vehicles. So we do need our cardio. We do need our lifting. We do need, you and I were talking about before we started the show, like I've been injured, right? And so I've had to switch to some cardio and it's not my favorite. What did I do? I threw on a weight vest. And so it's a little bit of lifting, stretching, balance, flexibility, agility. All of those things are important, and thinking about your portfolio in a similar way and making sure that the things that you add to it are additive in the function and in the purpose of your portfolio is important. So
I'm actually really happy you touched on like the purpose of it all, because I think people look at it backwards. They start with their investments first, where they're going to invest a certain way. And up until maybe the past 10 or 15 years, there's been the preconceived notion of how to invest where you have some sort of stockbroker. Like if you talk to my dad, he would think that I'm going to call him on a Wednesday at 11 and pitch him some sort of popular stock. And so people will work backwards where they'll invest in the investments. And then if it so happens that over a period of time, the investments worked out, they'll have a better retirement or they'll have a better situation. Where I look at it the other way, where we work with goals first, we develop a plan, and then we build the assets in a way that support the plan to achieve the goals. So when you're building these portfolios, I don't feel like, and I'm just assuming here, but I don't feel like your team or you or anybody is really trying to chase returns that are unrealistic. I feel like you're just trying to develop really high quality, diversified portfolios that are built to achieve the advisor or the advisor's client's goals. Am I right with that?
Yeah, absolutely. And even almost to the extreme. One of the things that we joke about a lot is how how much, not joke about, we talk about a lot, is how much back tests really do matter. Because they're one of the only actual tests that you can apply to a model, and yet at the same time they have no correlation with future returns. When we put models together, we literally look, like, our first matrix is, and it's a bar. And the bar builds as the bar, as you get better scores, the bar gets bigger. Um, of value and momentum and quality and size, and we can plug in any factor we want to, but that is what we're looking at when we're building a model, and we're comparing it to the model they had previously, and we're making sure that what we are building into this model is producing better characteristics overall. And then we go back and run the back tests and look at it from a different perspective to get more information and more understanding, and then we may go back and tweak it a little bit and then go back again, and we'll run it through like Portfolio Analyzer and some other tools that are available as well, so that we can kind of look at it from every angle. But our first build, our initial take at this model is simply what how do we maximize the utility, the function, the characteristics, the quality of this thing for the advisor. So,
Yeah, absolutely. Are you guys utilizing any specific benchmarks or anything? I know it's tough with factors because you mentioned momentum, size, volatility. So there's a few different types of factors that we've kind of touched on. But what do you, when you back test, which people like to talk smack about back testing, but it's all we have.
yeah,
It's run against real world scenarios that actually did happen. We
that's
all
all we
know
have.
that we
Yeah,
have throughout the disclaimer, I can't predict future results. Past performance isn't indicative of future results. But what are you using when you're running those scenarios? You back test it, spits out the data. What are you looking for where you're like, oh, I like that. That
yeah,
works well.
yeah. A lot of that is dependent on the client that we're working with. Sometimes we'll use their old model as just a relative benchmark for a back test. Um, we would never want to put a client in a situation where we're handing them something and saying, "Good luck. It doesn't look like it did great next to what you used to have." So, we definitely keep that and consider that as we build out. A lot of times when we're building an equity only, like when we're looking at the equity only model, we benchmark that against the S&P 500 just to get an idea of whether or not it would have produced alpha or at least a smoother ride. Really, again, that goes back to what the advisor is looking for, like what kind of clients they have and what they've indicated they talk about a lot with their clients. Some advisors want that smooth ride. Some advisors want to have always asset class that's outperforming, ideally, so that they can talk about what's doing well. We have some, depending on when they rebalance their portfolios, that matters, so that they can have some highs and lows to work with there if they do some tax loss harvesting. So those conversations can get very specific to what the advisor is looking for really quickly. But usually after we build, we go back and look at it against their previous model and then at least take the equity sleeve and compare that to the SP.
Yeah, absolutely. So I have an analogy here in a second, but I
Yeah.
want to ask you this. When you're building out the models, we use all the factors. It usually comes back where the deliverable to the client is a percentage. This holding A is this percentage. B, C, D, E, F, G. They're
Yep.
all percentages of the assets that are going to be invested. So 10% here, 7.5% here, 15% there. How often are you helping the clients change those percentages, or do you have recommendations on how often those percentages should be updated? Or what more people like to utilize is the allocation. Like,
Yeah.
how often should the allocation be changed or updated, you know?
Yeah. Yeah. So we have a couple of different types of advisors that we work with. Some that are looking to make a whole model change. And that in that case, yeah, we give them, this is your model allocation for aggressive all the way down to conservative. And based on your client, here's the percentages that you should be looking to rebalance into. And so they're going through meeting with clients, making changes to the whole portfolio. And we also have some clients that come to us that have like equity sleeves that have kind of rolled over into their way of managing their model. Maybe they came from like Merrill Lynch and they had SMAs there that were managing equity sleeves and bond sleeves and whatever. And now they've grown to the point where this is just too complicated. It takes too much time. They're doing all the trading themselves again because they're independent RIA and they're not trying to outsource that or add any costs to their trading or investment work. And so we're helping them simplify that. So it may be that we're taking equity allocation or this 10% allocation that they apply to some of their clients and rebalancing that. So in some ways that those instructions and those methods are different depending on which type of client that we're working with. But the focus throughout all of that, like you zoom out, big focus picture is one, change is always scary. I mean, it's always scary for the advisor, but because the advisor is the client thinks that change is scary because the client is usually less educated, or the client is more skeptical because they're a couple of degrees away from the reason why these changes are being made. And so they've got to manage the behaviors and the emotions in a way that we don't. And so there's a lot of intentionality in the way that we roll this out with each client to make sure that this is not just we're not just saying this is the best portfolio here, do it. It's okay, here's what we believe is best. What do you think about that? What parts of this do you have questions about? What parts are you feeling a little uncertain about as far as rolling out to your clients? How can we strategically roll through this? And, if it's somebody that rebalances quarterly, we may just rebalance a little bit of their equity sleeve at that, quarterly rebalance and not do the whole model. And that's totally fine. And it may be that new clients get put into this new model immediately, but clients that they already have take a little bit of strategic journey to get to that overall allocation because ultimately helping an advisor build their business is number one for us. It's not just telling them how to be the most right in their investments because the most right in their investments is to have clients to stay in them. And so we can't do anything that would jeopardize that for the advisor. And we know that, we respect that. So it's a lot of times it's a bit of a journey to get there.
Yeah, that's awesome. And what I've talked to a lot of people recently, and I've even done it myself since last year was such a tough year. And then even, I guess 2018 would have been the worst year before that. And then from 2018, the last bad year was like 2010, 2011.
Yeah.
In those tough years, there's sometimes tax loss harvesting opportunities. And for people that don't know, just tax loss harvesting is in a taxable account, like your trust account, your joint brokerage account. You have an asset, you invest in it. Over a period of time, it actually loses value. You have the opportunity to sell it, take the loss to offset maybe a little bit of income or some future gains to protect some future taxation, which is a tool I did a ton last year. How much do you help with tax loss harvesting, or is that more on the advisor/client side?
A lot of times advisors are seeking that out from other sources. I know
Mhm.
most recently, like Altruist has provided a tax loss harvesting option inside their trading system. And so the advisors have the opportunity to go in there and flip that switch and make that an automatically occurring event
Mhm.
for the models. And again, there's a lot of nuances and details in that Altruist could flesh out. But all that to say, a lot of this is being facilitated more and more automatically through various types of tech. And so we provide some education around tax loss harvesting. We have quite a spicy article out there that says there's no alpha in tax loss harvesting. You'll have to go check that out. But ultimately the behavior of it is and the perception by the client that the advisor is taking the initiative on assessing and looking for these opportunities with a client speaks a lot on the relationship and the quality of the advisor. So it goes into that bucket of advisors who do tax loss harvesting are typically advisors who are looking for opportunities for their clients to win versus advisors who ignore it completely with no purpose for ignoring it, just haven't explored it. May not be looking for as many opportunities for their clients to win. Um, it, that to me can kind of separate out some maybe behavior alpha on the part of the advisors that the article might not capture. But the article is interesting in the sense that it really does raise the question of what activities are we doing on behalf of the client that's truly benefiting them in the long run, and is where does tax loss harvesting fall in that in that regard, and I think that again pulling back and looking at an analogy from CrossFit is you know is there more power output from someone jumping on a 20-inch box versus someone jumping on a 12-inch box? Absolutely. There, no question, there'd be more power output for jumping on a 20-inch box. But if they can't jump on a 20-inch box, do we just tell them not to jump on boxes? So it's a lot of times just a nuance decision of let's do what we can for the client to the best of our abilities and combined with what they will tolerate and what we are capable of executing on well and live in that zone versus just piling on a lot of activities and striving for something that we can't execute well. And so I see advisors doing it well, and then I also um, see instances where it may not be as beneficial for the client as it looks like it is. So, yeah.
Yeah, there's been a lot of scrutiny with that. Well, first, send me that article. I'll link it below
Oh,
so everyone can take a look at it.
sure.
But there's also been scrutiny against the daily tax loss harvesting because there's now software that in a taxable account, they'll tax loss harvest daily.
Yeah.
Like an investment will go down by a little bit and it'll harvest it.
Yeah.
And you'll end up getting a portfolio. I've seen these where it started with maybe 6 to 10 holdings and now it's at like 20 or 30 because you
Yeah.
can't buy back in right away because of wash sale
Correct.
rules in some cases. And they'll have this portfolio as long as my arm for no apparent reason
Yeah.
because of daily tax loss harvesting seemed valuable. So
Yeah.
I definitely agree. And I love the CrossFit analogies. If people haven't picked up by now, Jess and I share a very similar passion towards the quote unquote sport of CrossFit.
Yeah.
Uh, you've coached for a while. I coached for 8 years.
Yeah.
And then I haven't done it since. I have a couple kids and run the business. So I'm not coaching as much, but I know exactly what you're saying, where there are people that come in, and this is kind of the analogy I want to make to what we were talking about investing before. There are people that will come in off the street really excited. And so they'll just start going at it. Whatever
Yep.
it is, it's a muscle up. or it's really heavy snatches or really heavy deadlifts or whatever it is, they'll just go at it. And that's how a lot of people approach investing. Like the first thing to do is just go in and just start doing it, where pulling it back and kind of slowing it down creates that long-term value, focusing on the movement, focusing on the stimulus, maybe weak areas, whether it's mobility or strength or even nutrition. That's the
Yeah.
same thing with investing. A lot of people wanted, like they did in 2020 with Robinhood, they just started investing and they ended up hurting themselves quickly, where they
Yeah.
maybe need to slow down and really start to learn and adapt to the new investing environment. And I think that's what your company can help advisors do with clients, is develop a good, properly built portfolio to start this investing and like wealth journey. Or if they're already kind of built into the investment journey, just kind of fixing what they're already doing, getting them on the right path for sure.
Yeah. Yeah. No, I appreciate that. I've been coaching for 13 years, so I'll one up you a little bit on that.
Yeah, you will.
No, anything, if anything, and I was talking about this earlier with regards to finance, the more you know, the more you realize you don't know. So, if anything, I just know less than you now. It is just it's a world that is never ending from a learning standpoint. So much of it is because everyone is different, and the ability to unlock someone and help them get where they want to go is an individualized journey. But no, I appreciate you saying that. We certainly do approach this as a opportunity that some advisors started off giving us, and then we've recognized is it like I said, it's a win for us, and that's something that was already a part of our value system from the beginning of building ETFs. And so one of the things I was most insecure about coming into this industry was the fact that I didn't understand investing and that nobody was willing to teach me. They wanted to teach me how to sell. You probably experienced that at Edward Jones. If people trust you, like you could just lean on our investments are great. Just you don't have to know about them. They're here because they trust you. Take their money and put it in a portfolio and keep moving. And that was something that it bothered me because I wanted to feel confident and I wanted to feel that conviction about my clients' investments, no matter what, knowing that no matter what happened in the market, I had invested them properly and that they were going to be able to weather any storms. And so I just kept asking, kept asking, kept asking. And so I feel like Alpha Architect is that company that is solving for that insecurity that I felt as an advisor, as I wanted to go out on my own and didn't know who I could partner with, didn't want to raise costs for my clients just because I didn't know what I was doing on the investment side. I could put together a plan and that's where I see a lot of advisors going. They can put together amazing plans. They've been taught, thoroughly taught as financial planners, and there's just either some insecurity or lack of desire on the investment side. And so they've just abandoned it and they've centered their business around planning only. And I think that's fine if that's what you want. But if you're doing that because of an insecurity or a lack of desire because you don't feel like you can do it well, then it's really cool to be able to solve that piece of the puzzle because it brings in another stream of revenue, another way for an advisor to grow a thriving business for themselves and their families. And so I just feel really grateful that we get to sit there in the center of all that and put those pieces together.
Well, it's the same thing as a CrossFit gym owner. Like there are a lot of people that want to start a CrossFit gym. They start a CrossFit gym and they don't know how to program on a day-to-day basis. They don't know how to cultivate the right workouts for the clients that they're working with. So they outsource it. They'll go to Comp Train or Mayhem or Hard Work Pays Off or whoever it is out there. There's a lot of them that are third-party programmers that you can pick so you can focus on coaching, because coaching and programming are two different things, just like financial planning and investment management are two different things. Sometimes there's overlap, but they're different. But in the CrossFit or fitness world, if you want to coach and like build a business, you don't want to bring in poor programming. You want to
Right.
bring in good stuff from a third party that's well thought out by a good team, so you can just implement that and focus on delivering that. And I
Yep.
think that's basically what Alpha Architect is in my mind.
Yeah. 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 So it's a privilege to partner with advisors, and they want to do a great job with their clients, and that's who we see. That's who we work with.
Yeah, I love it. So I would be very upset if we didn't talk about fitness a little bit. And here's what I mean is I believe that if you can have $10 million, $20 million, whatever it is, but if you're 72 and you have trouble getting off the couch, or you're unmotivated, you don't have the physical capacity or the body to support the vision that you want, that money is essentially charity, because you're not going to be able to use it the way you want.
That's
So
right.
what have you seen in your 13 years as being a coach? I would assume, I'm probably asking a loaded question, but I would assume that you see or have experienced some sort of differential happiness in people's mentality and their physical happiness when they really focus on their health and
Yep.
wellness.
Yep.
Is that right?
Yep. Two things. One is people who truly accept where they are in their fitness, meet themselves where they're at with no judgment, are the happiest in the gym. So people who are constantly striving or constantly frustrated with themselves for not hitting a lift, or not getting a certain time, or not being at the top of the leaderboard or whatnot. It's almost like they have this wrong perception of their own fitness, or they're RXing WODs where they shouldn't be. And it, it's, you could call it ego, but it's just like this lack of perception of what their actual fitness is. And so people who understand, like, meet themselves where they're at, give themselves grace on days when they're having a bad day, just humility and kindness with themselves, and a love for an appreciation for their fitness, is one. And then two, like, the second thing that I see for people is, then what do they do with that? How do they express that? What are the ways that they take it, even either outside of the gym because they go to CrossFit competitions, or they go hike mountains, or they, use it to do fun things with their kids. But, like, it's the expression of that fitness, and like and just an enjoyment of the gift that they have of fitness. Those are the two, like, those are the happiest people that I see in the gym, for sure.
Yeah. So as far as number one goes, I couldn't agree more. And I'm probably the worst gym backseat driver. So here's what I mean. I just go to the regular class and I'll do a little bit extra on my own.
Yeah.
But I will go by people, regular people in the gym, and I'll just like breeze by them and say, "Hey man, don't do that weight." Like, I'm that guy. I'm that guy. Like, I've seen enough. I've been there
Yeah.
enough
Yeah.
where because if you want to get technical, they lose the stimulus.
Yeah.
So it'll take
Correct.
them too long in a workout, but also their form will break down. So they'll expose themselves to potential injury or harm because they're lifting too much weight. But also, they forget about the value of a little bit lighter weight and going faster,
Yep.
and how
Mhm.
much that'll improve just their regular fitness that'll bleed into other things. So I don't know. Ego is probably it. Like, some people do have ego, like they think they're better than they really are, which is like the ex-athlete. They played college football. If I hear another ex-college football player get mad at a CrossFitter for being good at CrossFit, but they're not good because they play football, I'm going to lose it. So that person, which was me, there's that. And then the next part is, yeah, what are you using this for? Because CrossFit's the first one in the industry where they're like, fitness is medicine.
Mhm.
Fitness is medicine. We're going to battle against large organizations, really explain that this is medicine. Being able to use that outside of the CrossFit gym, I think, is one of the most valuable pieces of all this, which translates
I
to a really
agree.
good retirement.
I agree. I agree. Yeah. Yeah.
When you think about where this all goes from here, so people are investing, they're building their portfolios, they're preparing for retirement. They're in the fitness world in some capacity. You don't have to be in CrossFit. You could be going to
Yeah.
F45, but you're staying consistent. I view financial planning and I view fitness in the same breath, each with having a plan. So I want to ask you, where do we go from here? Like, what can people do or really take with them when they think about their future in their wealth and their future in their physical health? How do we start thinking about them together? And what are some of the initial steps you think we can take? Because just baby steps, like what's the first step you can take to really push the needle on both of them simultaneously?
Wow. So this, in order for us to get this right, I think we have to start with a huge dose of empathy and empathic listening to our clients, to not just ask the right questions, but even just to ask questions and then just really listen for what the client is not saying and be willing to ask the risky, maybe tough questions after you've built some rapport with a client. But what I mean by that is, in that initial meeting, if a client gives you an indication that they have a fit, healthy, active lifestyle, and there are things that they, do that run marathons or whatnot, just asking, hey, is this something that you want to continue to do, on into the future? Is there something that you would like to do that you haven't done yet? Is there a marathon that you would like to run? And maybe it's in a foreign country and they have to, it's expensive flights and travel and all of those kinds of things. And so you can help plan along those lines. But then also you may recognize that you get clients just as they may be having issues. We have a lot of clients sometimes that are struggling in their marriage and there's some ties to finances because of that. Maybe they're struggling with their health and there's some ties to finances because of that. Maybe they have a family member that has cancer or has had cancer and so they're struggling with, should I plan for that or not? And in order for you to be able to have a conversation with that person about those very tender things, you're going to have to be a safe person first for them. And so as you open up these conversations and pull the curtain back and pull that lid off a little bit, and you recognize that you're starting to tiptoe into waters where you you're brushing up against feelings about themselves and feelings about what they're capable of. Maybe you have somebody that would love to lose 100 pounds and go run a marathon. They've never done that before. Finances are a piece of unlocking that and understanding whether or not they can allocate some money toward that now in order to live their best life later is something that you may end up having a conversation with them about. And there's a question that I may just repeat it in every podcast from here on out. Forgive me, anybody who listens to podcasts that I do, if that's the case, because I just love it so much. But Carl Richards said it on stage. He was talking with Christy Archuleta at Shift Conference and Shift with an F, Shift Conference. But he said he was talking to a client and the client said something and he said, I'm sorry, you may fire me for saying this, but you should definitely fire me. Or you may fire me for asking you this, but you should definitely fire me if I don't. And I think about that question so much because it's such a great phrase to use whenever you're brushing up against a hard question that could potentially ruffle your client. And I think this wades into these waters with health and wealth and maybe asking some tough questions around ways that you can help them unlock that. A, a great way to just kind of prop that door open is, I have this question to ask you, and you may fire me for asking it, but I really believe you should fire me if I don't. And just wait, just pause, just see what they give you, see if they give you space to keep walking through that door. And look for phrases like that that can help you enter into that space with someone in a safe way and ask those tough questions so that you can get to a place where you can help them start planning around that. And then also know your scope, right? If you're not a nutritionist, if you aren't, especially if you aren't a nutritionist, don't give them nutrition advice. That can get you a ticket to jail in some states in the U.S. And so, but have partners. So I don't think it's out of the realm of possibility now that we're starting to look for our bench of experts. Like consider a health expert. Consider knowing someone that you could reach out to, whether it's a CrossFit or some other personal trainer, nutrition expert that you could reach out to, that you could recommend them connecting with once you connect with a client who's looking to invest in their health as a way of extending their future.
Yeah, that should definitely be said, that we're not medical professionals and we're not nutritionists. We are CrossFit coaches, but we don't have all the answers. But I think what
Ever.
you're really touching on that I think is the new realm of financial planning is being someone's like support group, their support system. Like
Mhm.
I can't tell a person that may have heart problems to just go lose 100 pounds.
Right.
But if that's important to them and I find out somehow that that's important to them, maybe I could just be their support group, be someone there for them as they go through the process. Because I think the biggest thing you touched on was empathy. Everybody's experience is so different
Yeah.
for however they got to where they're at today, that I think us just being able to dive deeper and help push the needle for them is one of the most valuable things we can do, along with all the technical aspects of retirement planning, investment planning, financial planning, and those things that everyone loves to talk about, the sexy stuff. But just being there for the people, showing them that we care about them and their vision, I
Yeah.
think might be the best thing that we can do as we move through this.
Yeah. And I'll just tag on to that. Dr. Phil Perlman is doing a lot of incredible work in this space as far as creating resources for advisors and advisors who want to provide health, wealth resources for their clients. So if you're looking for an expert, someone to fill your bench, some resources in that area, I would definitely look into what Dr. Phil Perlman is doing.
Love it. Dr. Phil Perlman. And tell everyone where they can find you.
You can find me on Twitter. As I mentioned, I love it there. So you're welcome to find me there. I'm at lady 2_ Bost, Bost. I'm on social media as Lady Bost in a couple of different spots. So you can find me on Instagram. I was really big into that during the health and fitness aspect of my life. That was kind of a place for fitness folks to gather. I am perusing LinkedIn. And so you can find me there as Lady Bost as well. And Facebook's just for my mom. So you wouldn't find anything interesting about me there. But no, I'm around. And then also if you just Google alphaarchitect.com, you can connect with me through there.
Love it. This was phenomenal. Thank you so much. I bet everyone
Thank you for
got
having me.
a little nugget or two they can take with them. I appreciate it. Maybe we'll do this again in the future.
Yeah, love that. Thank you, Thatcher.